Welcome back to another Meet Kevin report. Today we are covering the good old producer price inflation report. We're also on episode 81 of the Meet Kevin report. Welcome on in. All right, PPI comes out in about 20 seconds. We are looking for good old data that is going to hopefully reiterate the declining CPI we saw yesterday. Final month over month, we were looking for 0. We are looking for X food and energy of 0.2, X food energy trade of 0.3, year over year, 3% PPI inflation, 3.4% year over year X food, energy, and energy trade, that is PPI X food energy trade looking for 3.8. Here we go. Oh, yes. Okay. Big old Midas. Negative 0.5% month over month on PPI final. That's really good. PPI X food energy trade 0.1%. Let's go, baby. Inflation's going away. It's finally turning transitory. Look at that. PPI final demand year over year was expected to be 3.0, comes in at 2.7, also below expectations. PPI X food and energy was expected to be 0.2. We got negative 0.1. Let's go. This is great. Year over year, we did get PPI X food and energy matching 3.4, 3.4. PPI X food energy trade expected 3.8. We got 3.6. So we got big misses across the board here. Initial jobless claims were expected to be 235,000. We got a 239,000. We were looking at continuing claims of 1.833. We got 1.810. It does show a little bit of strength there still in the labor market, which is good, though, because you don't exactly want a destroyed labor market and a destroyed economy, but you want inflation gone. But that's literally what's happening here. This is fantastic. This, in my opinion, reiterates, look, the Fed can hike in May and go away. This is great. We do not want inflation to stick around, obviously. And now keep in mind, and we're going to look at the PPI BLS in just a moment, pull it up. Keep in mind, I see this comment like every single day, but every single day I talk about inflation, I see people, but Kevin, I went to the grocery store and stuff is still expensive. Yes, we know prices went up, but that is not what the Federal Reserve is fighting. The Fed is not fighting that things are expensive. The Fed is not fighting that things got expensive. The Fed is fighting that things are continuing to get more and more expensive. And right now, fortunately, that is finally transitioning away. Let's take a look at the producer price index. This is absolutely fantastic. Look at this. This month over month figure, keep in mind, this was expected to come in at 0. The expectation was 0.0. What we actually got was negative 0.5. This is really good. BLS final demand prices were unchanged in February, increased let's see, what is this here? Final demand prices were unchanged. February increased 0.4 in January. That is the, let's see here. Final, okay, here. Producer price index for final demand declined 0.5% in March, seasonally adjusted by the BLS. Okay, then they go back into February, was 0.4, unchanged in Feb, and 0.4 in Jan. So what you're really seeing is sort of that declining in PPI. That's what they're really trying to show you here. 0.5. Here you had 0.4 in Feb. I guess it'd be the other way around, but I think you get the idea. And Kevin, wake up. 0.0 here in Feb, 0.4 in Jan. That's what they're trying to show you. And here we are in March. There we go. Okay. 2/3 of the decline in the index for final demand can be attributed to a 1% decrease in prices for final demand goods. There's that manufacturing side, right? There's that disinflation happening in manufacturing. In my opinion, that's your consumer staples. That's sort of your regular consumer products that people just aren't spending money on anymore because either they've hoarded enough of it or they're like, crap, if we are going to go into a recession, because now even the Fed's talking about it, maybe we ought to save a little bit of money. Prices for final demand, less food, energy, and trade edged up 0.1% in March after rising 0.2% in Feb, right? That's fine. We went through those numbers already. That was expected to be 0.3. So the expectation for that number was this number right here was 0.3. So we pretty much missed on every side here. Let's see if we can get a little bit more detail here. Product detail, a 7.3% drop in margins for machinery and vehicle wholesaling was a major factor in the March decrease in prices for final demand services. Oh, really? For services, final demand services, for machinery and vehicle wholesaling. That's really interesting because we've been seeing negativity on what's it called? We've seen this negativity on products, but to see it on services as well is good. The index for transportation, freight, portfolio management, fuel, lubricants, retailing, loan services, automobiles, parts also moved down. All of those I just mentioned here, well, most of these, truck transportation, freight, portfolio management, those are all services, loan services. That's great. Prices for guest room rental rose 4.6%. Okay, guest room rental. What is that like almost like an Airbnb? Index for food, retailing, and transportation for passengers advanced. Okay, it's fine. So what do we got? Let's see here. Foods, energy, transportation, warehousing, fine. Processed goods and intermediate goods declined 1% in March after moving down 0.4% in February. A major factor in the March decrease was a 5% drop in prices for processed energy goods. Well, that's okay. I mean, we have seen, and this is why we purposefully look at some of these numbers excluding energy. Remember, final demand, not excluding energy, came in at negative 0.5%. And then when we exclude food and energy, we got negative 0.1. Exclude food, energy, trade, we got 0.1. And then same thing for the year-over-year numbers. But these numbers really came down nicely. Now, do keep in mind, we did get revisions for the prior release. So February did get revised up a little bit. Final demand went from instead of negative 0.1 to 0. Food and energy went from 0 to 0.2. So you had some upward revisions here. Year over year went from 4.6 to 4.9. 4.4 on X-Food Energy year over year went to 4.8. X-Food Energy Trade went from 4.4 to 4.5. So the revisions are not that great. The revisions definitely hurt this report a little bit on the prior, but this is very good for this month at least. All right, let's keep looking here. Product detail, 1/3 of the March decrease in prices for processed goods for intermediate demand can be traced to a 6.5% decline in diesel fuel. That's okay. Again, that's why we exclude energy from some of the numbers. And even if we exclude energy, we get some big movements here. Let's see here. The index for unprocessed goods for intermediate demand moved down 5% in March, the largest decline since falling 9.7% in October. The broad-based decline was based on unprocessed energy goods, which dropped 11.5%. The index for unprocessed foods and feeds also moved lower. Fine. All right. Crude oil fell a lot. Fantastic. We know China's reopening didn't pump oil like people thought it would. That's great. We also know that OPEC's price, or I can always say price, OPEC's production cut was really supposed to drive oil up substantially, which it did. I mean, Brent's at $87, and the last month we were significantly lower. In the month of much of the month of March, we were sitting around $75, $75 to $78 for Brent. So we're going to be getting some reinflation next month because of these energy prices going back up this month, unless they start falling again pretty rapidly. But that might not be such a terrible thing because, again, we're looking at inflation numbers that exclude a lot of the energy numbers, and all of those missed pretty decently, which is good. Okay, let's see if we can get some more tables here so we can see some actual products. But this is fantastic news. This is a great point while I pull up the chart here to mention that if you want to get super powered book summaries, check out short form. A really great way to inspire you to potentially check out the entire book. Like, for example, one of my favorites is this book called Good to Great. Really, actually phenomenal book, especially if you're trying to run a business. Really excellent. Everybody should read the book Good to Great. But if you wanted to start with a super powered book summary, go to shortform.com/meetkevin. Their sponsor, link down below. I think I pressed that button. Yeah, there we go. Anyway, go to shortform.com/meetkevin. Check them out. All right, so let's look at the actual charts here. Now that we got this up, I want to see where numbers are going down. And let's quickly also see here, seasonally adjusted change, 1 month % change. So we want to look at the far right column in this one. So far right column, what do we got here? Durable consumer goods, 0.2%. Those are like appliances. Fine. Final demand services. Oh, thank goodness. Look at that. That's what I want to see. This is what you want to see. Look at this. Final demand services. This, by the way, has a 66% weight I'm pretty sure. Hold on. Let me make sure that's the weight. Relevance. Yes. Okay, good. Look at this, folks. 66% weight of PPI is final demand services. And finally, for the first time in at least the last 3 months over here, I think we could even go back to 4. Let me double check. Oh, look at that. 1, 2, 3, 4, 5. 5. We can go back 5. For the first time in the last 5 months, we've actually had a negative read on final demand services. Thank God. Final demand trade services, negative. Finished goods, negative 0.7. And these are big negatives too. Look how negative this is. This is finally starting to make it look like inflation is starting to be transitory. I know people are like, that's a terrible word, but it's finally coming true because look, what happens is first PPI falls. Then you have to remember there's a big lag, and then it shows up in CPI because when the production prices come down, then you don't have to raise prices as much. Not even that you could raise prices as much because people are demanding less. But anyway, there's a lag between the two. But this is fantastic. So final demand services in aggregate down 0.3%. That's awesome. That's literally 3.6% deflation on an annualized basis. That's wild. Final demand trade services minus 0.9. I mean, think about what 0.9 means. 0.9 on an annualized basis is negative 10.8% deflation. Prices actually coming down. Trade of private capital equipment. Like this is like machinery right here. You want machinery right now? Coming up for sale, baby. Minus 2.4% on a month. Government purchased goods down 2%. Look at this. This is insane. Minus 4.8%. Trade of government purchased capital equipment. Trade of exports minus 1.5%. Final demand transportation and warehousing services minus 1.3%. But still, passenger transportation. So it's people, right? People are still spending money, but not on stuff. So this is where we are seeing some of the stuff, some of the items, but it's interesting that in the services for goods, that's where you're seeing a lot of these negatives. It seems to be. All right, let's see what else we got here. Let's see. Transportation, lots of transportation. You got some mixed reads over here, but a lot of this transportation stuff is actually negative. Oh, that sounds like Mario. Here, anything with passengers is positive. Okay, fine. What do we have here? Final demand services, less trade, transportation, and warehousing. Okay. Finished consumer services. Only 0.2%. Well, that's good. Final demand services, less trade, transportation, warehouses, 0.1%. That's fantastic. That's really good. Okay, well, I like to see that. Final demand construction, 0.2%. Fair game. Totally fine. There's nothing scary in this report at all. This report is freaking awesome. This report is great. It's a me. Final demand, less exports, negative 0.5%. Final demand, less government, negative 0.5%. Blah, blah, blah. Okay, it's so negative. It's crazy. Final demand, goods, less energy. This is the highest thing I've seen here, 0.4. But that's interesting. 24.8% final demand, goods, less energy. So, energy really tanked a lot of this, it seems. But energy is not going to tank your services. This final demand services over here. But it would make sense that it would tank some of your goods prices. But then again, even in aggregate, what we say without energy, we're looking at PPI X food energy trade 0.1%, X food and energy negative 0.1%. Yeah, that's fine. Okay, what else do we have here? Let's see here. Finished goods, finished services. See, look at that. Finished services, negative 0.2%. Yes, very good. Finished goods excluding foods, negative 1.8%. Finished goods excluding energy. So if you only exclude energy, it's interesting, 0.6. But then, so if you only exclude energy, does that, it looks to me like foods then really pushes this up. So maybe foods are what in goods push this up. Because when you do goods minus food, you get negative 1.8%. If you do goods only minus energy and not food, you get 0.6%, which is pretty high. So that suggests food really popped up a little bit. We should be able to see that a little bit more clearly here somewhere. We'll keep looking for it. All right, total finished, less foods, minus 0.5, less energy, flat, fine. An aggregate of all, 1.2. Okay, good. Total exports, goods for export. All of this is negative. And just look at this. You don't even have to read it anymore. It's just all plummeting. All of it. Personal consumption, negative 0.4%. What else here? Yeah, as soon as you take out food, look at that. Personal consumption of goods, less foods, negative 2.9%. So foods must have had a big pop there to weigh this up so much. Processed goods, manufacturing for foods, manufacturing components for construction. Construction is still getting a little boost here, 0.5%. Okay. Unprocessed goods. These are feeds for animals. Fine. A lot of these numbers will be up for the energy products next month because of the volatility of oil. But that's okay because once we look at less energy, you're still looking at good. No, but that's interesting. Oh, these are stage 4 goods because here food is negative. It's a little bit more of a complicated report. See, here we go. Inputs to stage 4. There we go. Foods. Yeah, foods were up a little. Okay, that's fine. But foods are one of those volatile ones. And that's why we generally say X, food, and energy. Because on a month-to-month basis, these things are flying around. And again, what's more important here is seeing some of these services start coming down. Trade services down 0.1%. Services across the board, 0.5%. Except for passengers. That's one part that's moving up. Okay, anything else? Let's see if there's anything that really stands out over here. No. Stage 2, looking for something that stands out. Services, passengers, energy. We know energy fell a lot. Stage 1 food fell 4.4. Okay. Inputs to stage 1 service producers, foods. Yeah, there are definitely some parts of foods components that were hot in this one, but beyond that, this is all negative here. This is pretty remarkable. Wow. Okay, that's really great. So that gives us our PPI numbers. Now, what I'd be curious to see is how the Fed rate monitor is moving as a result of this. Let's see here. All right, Fed rate monitor. All right, let's see what we have. Rate monitor right now is looking at a 69% chance of a 25 BP hike in May. And then we're looking at a 67% chance of a freeze in May, or sorry, in June. So in other words, hike in May and go away. Some people are starting to price in with a 28.6% chance that we get a 25 basis point cut, or that we actually have frozen in May and then stay frozen for June. Indices now turning slightly positive. Dow up 13 basis points, S&P 22, NASDAQ 36. 10-year Treasury sitting at 3.39. So down just a smidge here. And oil's down about 0.5% here. So what does this really mean for the Fed? Well, let's see if we have any commentary from Wall Street on this. I mean, in my opinion, this is fantastic. This is exactly what the Fed wants. The Fed does not want to have to create a recession, but they will if they have to get rid of inflation. That's always something you want to remember. They will force a recession if they have to get rid of inflation. But are we, is it necessary to create a recession if inflation goes away? No, of course not. Then they turn the money printer back on. PPI provides dovish surprise. The claims data was broadly in line with expectations for initial filings. More notable, however, was the unexpected decline in PPI, which undershot expectations by a considerable margin across every aggregate, falling 0.5% on a headline basis. There were some upside revisions to prior data. Correct, I went through those. But in aggregate, producer price inflation looks a bit lower than expected. That would provide another argument in favor of an end to the Fed cycle coming shortly. Though, given some of the trends in energy prices, it may well be the case that PPI starts ticking higher again soon. Well, yes, we talked about that. Brent's up 10%. or sorry, not 10%. It's up a little bit more than 10%. That Brent's up like $10, right? So, I mean, you're up like 13% on oil month over month right now. But that's why we look at these numbers excluding oil. So next month is going to be a little bit more granular, where we'll have to go through a little bit more and go, okay, so that's related to oil. But that should be pretty obvious. Yields drop on PPI data in headwind $4. Yields dropped on data. Meanwhile, jobless claims were pretty much in line. PPI below expectations, right? Let's see here. What is this? A pervasive deterioration in consumer in continuing claims data across the United States is consistent with a recession beginning very soon. I didn't see the jobs claims data actually deteriorating. Let me see here. Initial claims came in 4,000 higher than expected, but continuing claims fell from the survey and from the prior report. The survey was 1.833. The prior release was 1.823. The actual was 1.810. So what do they mean a continued deterioration here? A pervasive deterioration in continuing claims data across the U.S. is consistent with a recession beginning very soon. Historically, a recession should mean stocks making new loans, but this cycle is proving odd, and this should not be taken as read. A very reliable and a very rare technical signal points to a long-term constructive outlook for U.S. equities. Very reliable and one very rare. Okay. This is why. Can they not write English here? Hold on. Percentage of continuing claims has never hit this level and not gone on to spike much higher. Oh, I see what they're saying. Okay. Here, let me show you a screenshot of this so you can see what they're talking about. Okay. That's not necessarily from this percent of the United States. Okay. All right. Fine. So let me pull up. I press this button. Yeah. So here's the chart that they're showing. Percentage of U.S. states. So this is a percentage of U.S. states. So this is very different from the headline number, but it's a percentage of U.S. states with an annual change in claims rising 30%. So as soon as you get more than, 18% of states seeing continuing claims rise over 30% on a 4-week moving average, as soon as that goes above about 18%, you've always seen it rise substantially higher, is sort of the argument they're making. We're basically there right now, which is quite interesting on continuing claims. But I want to understand what they're talking about here with this. One very rare technical signal points to a long-term constructive outlook for equities. Why? Let me click it. Let me see what this is. Rare buy signal hints that worst is over for stocks. Let's talk about that in another segment. So let me give a quick summary here on PPI, and then we'll talk about that. So quick summary here. PPI, look, PPI was great. PPI was great, and your PP-related stocks should be very happy today. Any kind of pricing power stocks should be very happy today because your input costs just went down. I think this, once again, reiterates the Fed 25 BP in May and then pause. And they're going to pause for a long time until inflation is convincingly dead. But that's okay because the longer they pause, the longer we're not in a recession. And the longer they're paused, the longer inflation isn't a problem. Think about that. The pause on both sides is good. Pause rate increases, inflation, no problem. Pause and not cut, no recession. So you want to pause and kind of hang out there as long as possible. That's your most optimistic scenario. So very excited about that. Let's get into the next segment. So thanks for watching the PPI segment. All right. Now, let's talk about rare buy signal. Oh! Kevin, loved your video on life yesterday. Oh, thank you for that. Same. Pumped me up this morning. I pumped Steve? I'm honored. No, well, thank you for that. No, it was sincere. It was, I wanted to just share some. We're always talking about these numbers and the, like in Wolf of Wall Street. It's all the granular. And I think it's good to talk about reality too sometimes. Mm-hmm. Oh, man. I went to Colorado to look at real estate. And you know what sucks? It's so freaking dry. I love Colorado. Okay, don't get me wrong. Like, Denver's awesome. But Utah's dry too.
Both of these places are so dry. Like my lips are so cracked. And like regular lip balm doesn't even cut it over there. You need like wax. It's so bad that you go into houses for sale, rather than like giving you like fresh baked cookies or something, they give you lotion. You can't make it up. It's crazy. It's just absolutely crazy. Hot water warms you up. I don't really understand what that means, but okay. All right, rare buy signal. Let's talk about this. All right. A purely based okay, here we go. Here's an article that basically just feeds right into the beautiful deliciousness that I'm looking for every single day. It just makes me tingle inside because it makes my bullish bias get so happy, and it just makes me feel so comfortable in my Christmas sweater. It's an article that's titled Rare Buy Signal Hints That the Worst is Over for Stocks. Is this a piece in Bloomberg that could potentially be reiterating the Nike swoosh? May think so based on the title, but I haven't even read the article yet. I just saw the title and I'm like, we have to talk about it. So let's take a look. A purely price-based signal. Oh, so it's technical based. Okay. A purely price-based signal suggests the bottom is in for stocks, despite several lingering risks. This is by Simon White. This is a hard column to write. Oh, is it? Deposit flight, poor liquidity, weakening earnings, a credit crunch, recession. It would be much easier to list reasons why equities should be lower. But that doesn't necessarily mean it will be, as anyone who has spent enough time in markets understands. They have a habit of being anti-utilitarian, causing the most people the most amount of pain. That's an interesting line, actually. Because utilitarianism is making sure you do the best for the most amount of people, right? But stocks basically do the opposite. It thus always pays to consider the other side of the case. But even with the best will in the world, it's hard to fully let go of one's biases. That's why technical analysis can be so powerful. But in this case, technical analysis is bullish. Some call it voodoo, but using market data to identify trends is as old as economics, dating back from the 18th century when Japanese rice traders used candlestick patterns to predict price movements. Recently, one very technical-based buy signal called the Kapuk has triggered, suggesting the long-term outlook for U.S. stocks is constructive, and the bottom is potentially already in. A rare but reliable buy signal for stocks. Fascinating. All right, I'll pull this up in a moment here. All right, what does it say here? The Kapuk is at base a momentum oscillator, which triggers when the medium and longer term measures of momentum begin to turn up on a persistent basis. Okay, got it. Moving averages essentially of momentum. Based on adapted parameters, it triggers only rarely. But the times it has triggered were October 1982, August 1988, April 2003, August 2009, and all of those were good buying opportunities. It outperforms the S&P average return over a 3-month, 6-month, and 6-month horizons, with the greatest absolute outperformance over 12 months, 19.1% versus 9.7%. Wow. S&P returns after. That's the S&P returns after you hit this. Okay, so here's a chart of what this reliable buy signal indicates. And so here you can see 82, great buy signal. 88, great buy signal. Soft buy signal here in the early 90s, which was also correct. 2003 April, very correct. And 2009. Notice this actually isn't at the bottom. Like if I draw a little arrow here, that's not a little arrow, but whatever. If I draw a big arrow, notice that the bottom actually came before the indicator triggered, right? So the indicator actually triggers once you pass a bottom, which makes sense because we kind of passed the bottom, December for some stocks. Some stocks was October, some stocks was July. So we kind of passed that bottom. Okay, now let's look at the returns. Oh, that's quite interesting. And see, this is why people are like, Kevin, why would you be in stocks? Treasuries are yielding 4%. And I'm like, that's nice. You're getting 4%. I'm going for 20% for the year. Some actively managed ETFs are already up 25% year to date. We won't mention any names because you have to go look and you have to net out fees and all this kind of stuff. And so that's why we just don't mention any names around here. But there are many. There are many different ETFs that have done very well this year. Kapak signal shows above average forward returns. S&P returns after the Kapak. I never thought I'd be so happy to say Kapak. Overall return period, data back to 1979. The 3-month Kapak gave you a 5% return on the S&P 500. The 6-month Kapak gave you a 10%. 12-month gave you that 19-ish%. Compared to periods of time where you did not have the Kapak indicator. All right, that's cool. The great appeal of technical signals is their simplicity. This technical analysis uses only the S&P's closing price on a daily basis. No economic data, no political interference, no opinion. It's fixed and it's unemotional. This also means signals such as the Kapak can trigger at very counterintuitive times, a signature of contrarianism and a hallmark of many of the best buying opportunities. Ooh, don't tempt me. The Kapak is previously triggered well before the Fed has started to hike again, when the ISM was under 50 and while unemployment was rising. As the signal is not trying to pick absolute bottoms, the S&P is generally already off its lows. That's true. We actually, that was one of the first things we saw, is that it wasn't really aligning with bottoms. And I'll give a little bit of a potential thesis on why this is happening. And then I want to keep reading about this because there's some other TA in this as well. But Kapak thesis, cop pick. No, that's not what I wrote, Apple. Stop it. No, I didn't write that word either. No. Okay, here we go. All right. Oh, geez. Oh, God. There we go. All right. So why would it potentially be possible that you could have this large downtrend and maybe that Nike swoosh we've been talking about, but why would that, let's call it what it is, Kapak. Why would that trigger here as a big buying opportunity? Well, aside from technicals, what actual reasons could we potentially give to this potentially triggering? Well, in my opinion, we have so much bad news, right? We have so much bad news, but inflation is actually trending down. Maybe not as exactly quickly as people had hoped or wanted, but the pain is not getting worse, right? And that's the one thing crushing the economy right now. And so when we look at everything else as like a symptom of the disease. Like, let me try to put it this way. I hate making this reference because it's so terrible to people who have to go through this. And I wish this upon nobody. And whoever has this affliction, I wish you a fast recovery. But inflation is frankly like cancer. Okay. And your vomiting is like the bank crisis. Your medicine is like, your chemo is like higher rates, right? Your hair loss is like hair loss. There we go. It's like earnings going away. Your fatigue is like cash going away, right? Like cash savings going away, and loss of appetite, you could call it, right? Whatever. Okay, so a little morbid, but I'm trying to make this comparison here. Okay, so everybody's bearish because of like people are looking at the economy. And people are like, dude, the economy's vomiting. It's losing its hair and it's losing weight. Like, this is a crap economy. But what if you're able to look and say, but dude, the cancer is going away. Well, then if that's going away, then eventually all of those problems will go away too. So yeah, there's a never-ending list of crap you have to deal with when you go through something as terrible as this. But if the actual cancer is going away, inflation, then eventually all the other crap will go away. That's sort of, if I had to give an explanation as to maybe like on a non-technical basis why the bottom may already be in, it would be that. Now I understand people are like, but Kevin, usually the stock market doesn't bottom until you're actually in a recession, and the yield curve is re-steepened. I know, but the weird thing is, everyone knows that, and so the irony is, when everybody knows that stocks bottom when the recession begins, it's possible that the stock market's like, well, if the cancer of inflation is going away and the stock market's going to bottom when the reinversion occurs, let me get in before the bottom. So that way I can, because we're not going to be able to perfectly time the bottom. Let's get in before so we can get good deals before and then ride the recovery afterwards, right? So it's possible that you sort of have that pre-pricing in of what's to come because that cancer of inflation is going away. All right, my thesis. Let's keep going on this. Similarly, did I, by the way, mention that if you wanted super powered book summaries to get you inspired to maybe read the full book, you could go to shortform.com/meetkevin. You could go through basically an entire book in 20 minutes because these are perfectly created and crafted, super powered summaries, they call them. And so 20 minutes, you could 2x, you could literally go through a book in 10 minutes. You're not actually going through the whole book, right? But you might get inspired then to read the whole book later. But if you just wanted to check that out and get a preview, it's a fantastic way to go through some of the core arguments within books. Check that out by going to shortform.com/meetkevin, and you'll get 25% off any of their subscription plans, which is pretty awesome. So make sure you go to shortform.com/meetkevin. That is a paid promotion. Look, I fixed the phraseology up here. I fixed the spelling. All right. Similarly, today does not appear to be a good time to buy with economic data weakening and credit tightening. But if we were to listen to only this signal, it tells us to buy and close your eyes. Another reliable signal, the Zieg thrust, has also recently triggered. The Zweig activates more often and does have false positives compared to the Kappa, but it is a good gauge of a medium-term trends of the market. Is this like a Jason Zweig, the intelligent investor indicator? Probably. I like that guy. That guy's cool. What is this? Brett Thrust. The New York Stock Exchange Zweig Thrust with adapted parameters. Okay. Good Lord. That's got a lot of green signals. But anyway, you can see it's activated over here. It looks like over here you had a little bit of pain after it activated once, and here you had some pain after it activated. So this one's not as reliable. I'd say it's reliable here, 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 over here. Here was great. This was too early. So there are a few occasions where it's a little too early. Here was definitely too early. Here's too early. But it seems like more often than not, that's probably at least somewhat correct. Okay. Stand by. Let's see what else we have here. Okay. Okay. Cool. The signal goes off whenever breadth, defined as the net number of stocks rising on the New York Stock Exchange, rapidly goes from being weak, very weak, to very strong. Thrusts higher. Oh, I love thrusting. Thrusting is fantastic. It shows good above average returns over the next 1, 3, and 6 months. If technical signal strength is their simplicity, it could also be their weakness. No trader or investor could ever take a decision based purely on them unless part of a more sophisticated quant strategy. Ooh, fancy. It would be tricky, to say the least, to explain to your client that you were long purely because of one moving average. Well, see, that's always what I think is so funny. is I actually think a lot of the financial advising industry is based on, well, how do I explain this to my clients? Seriously, I think most of the stock market and financial advising business is, how do I explain what I did to my clients? And so in 2022, oh, we are going into consumer staples because everybody's still going to have to buy toothpaste. And then the clients are like, yeah, that makes sense. And then now it's 2023. Gold is rising. And if we're going into a recession, historically, gold goes up and copper goes down. Yeah, that makes sense. And so you get this, like, all this trading and rebalancing of your portfolio. And it's really moronic because it just sets up a lot of commissions in the financial advising space, while at the same time trying not to have clients flee, right? Because if you have like a diamond balls approach and you're like, just give me pricing power stocks at good deals, people are gonna be like, but pricing power stocks are soft right now. Like, you're not protecting me. You're the problem. And then they go YOLO into gold at the top of the market and then it falls. And they YOLO into staples at the top of the market and then it falls. And then they come back to a different financial advisor because it wasn't, whatever. The whole business is screwed. This is why most people lose money in it. This is why I say, like, the easiest way to build wealth is real estate, because this business is rigged. But Kevin, you sell a course on stocks. Yeah, I do. And guess what I tell you? Stuff like that. And a lot more. There's some really good perspective in there. Okay, what else we have? It pays to incorporate these signals into your views. In today's case, the message is that despite everything pointing towards weaker stocks, price action is whispering that it might be wrong. In other words, stocks may have already bottomed. As already said, this was a hard column to write. Stocks could very well go on to make new lows before they exceed last year's high. But great buying opportunities only look elementary in retrospect, and it would be remiss not to point out that this may be one of them. Oh, tingle me on the inside. This may be one of the best buying opportunities, is what they're saying. What? I like this column a lot. This column talked right to my soft spot. She talked dirty to me over here. This is really cool. All right. Well, that was pretty cool. Somebody's saying, what are ways you can lose money on your ETF? Are you talking about me personally? Well, I have to pay for the dang thing. It costs me like $500,000 a year to run. That's one way. It's expensive. Financial industry is ridiculously expensive. But yeah, I mean, ETFs are based on price movements of the underlying stocks, right? Like, I don't even touch the money in it. It's like that's all basically done by other companies and stuff. So I just make the decisions. All right. Now what? I kind of want more coffee, but I want to see what's happening here. Let's listen to Jimbo for a second. Just what I need is more coffee. What's up, Jim?
And then I give her a pass. Yeah. No more pass.
Yeah, no, I think her credibility in your view is taking a hit.
Thank you. Thank you. I mean, look. I mean, you'll have people in the NBA, okay, and they will say, we didn't make the playoffs and we screwed up. But not in this world, because the NBA is real money, and these people are only just millions of jobs.
Okay.
Sorry.
All right.
Sorry that
I
am actually thinking about this and not happy with.
Wow, that PPI fall was the biggest fall since the start of the pandemic. That's crazy. Ooh, that's awesome. Awesome. Come on, YOLO calls, baby.
Retail sales tomorrow. And to Amazon today, Andy Jassy with his annual letter to shareholders. And in it, he commits to cost cutting and tech investments following what he calls one of the harder macroeconomic years in recent memory. As for AWS, Jassy writes the cloud unit faces some short-term headwinds as companies are being more cautious on spending. Here's what he told our Andrew Ross Sorkin a few moments ago about the future for the company.
I'm very optimistic about what lies ahead for Amazon, and I think there are a lot of reasons for it. I'd start with just a couple data points. If you if you look at our two largest businesses, if you look in our stores business, which is our retail business, we still only have, even though it's about a $434 billion business, we still only have about 1% of the worldwide market segment share in retail, and 80% of it still lives in physical stores. And if you look in our AWS business, which is about an $85 billion revenue run rate business, about 90% of that global IT spend is still on premises, not in the cloud. So if you believe that those equations are going to flip over time, which we do and we're seeing, we have a lot more growth in front of us.
That's been a common refrain from Amazon, both about the growth potential and also antitrust, right? We're small potatoes.
And they've got artificial intelligence, and they have Alexa. They praise. I don't know what I lose about 8 billion. 8 billion is not much. Dirksen probably thought that was not member Senator Dirksen. I'll tell you, he said something really interesting. He said that long-term stocks are a voting machine and short-term they're a weighing machine.
No, other way around.
That's leading up to my joke.
I'm sorry. Oh, you're making
because
a joke.
It's it. See, I'm trying to do a little like.
I kind of figured
Lenny
you knew
Bruce.
that.
Ladies and
Oh my
gentlemen,
God.
Lenny Bruce. Here we go. July 12th of 2021, the stock's at 185, and now it's at 97. So what kind of time frame is the weighing machine? Want to go back to like Wilkie?
It's long.
Remember Wim with Wilkie?
Listen, Buffett, of course, says that all the time. And
Well,
yesterday he was talking about things that happened in the 60s, in the 70s, in the 90s.
All right, we're going to pull back here for a moment. I'll tell you what the problem is with Amazon. This is the kind of stuff that we do in the course member live streams. We're going to be doing some fundamental analysis again this morning. It's going to be fun. But I much prefer being here in studio. But anyway, let's go. Let's look at Amazon really quick. I'll tell you what the problem is with Amazon. The problem with Amazon is really simple. AWS growth has slowed to under 20% at the same time as margins are compressing. But not only are you seeing that kind of pain, this is actually this is a Q4 number here. We should be getting. When are we going to get their Q1 numbers? Let me see. Amazon Q1 earnings report. Whatever. Oh, April 20. Is it? No. It's sometime within the next few weeks. Whatever. Oh, there we go. April 27th. Anyway, that kind of compression hurts. But not only that, the amount of money they actually make from selling stuff on Amazon is not really good. And you're also seeing a decline in it, 1.2% decline in their product sales. Their cost of sales, they purposely make hard to understand. They put their cost of sales here at 85 billion and their fulfillment at 23, and then their content at 20.8. But then they bundle all of that together into net product sales. And even when they divide out some of their other items for content production, you're still left wondering, okay, well, how do I divide out fulfillment and cost of sales? Like, they don't tell you Amazon.com costs this much and makes this much. They don't do that. They purposely make it blurry by putting together some of the other expenses that they have. And so really, I think what they're trying to do is they're trying to cover the fact that they don't make money when they sell you stuff on Amazon. So when you're buying stuff on Amazon, the seller, like the goods manufacturer, might make money, but they don't make money. Like, think about this. Where's it? I thought oh, it's not here. What's it called? I bought this ski jacket and outfit thingy. And let me see if I have it handy here. I'll show it to you. Oh yeah. Look at this. This is ridiculous. Okay, like how do you make money on this? Yeah, I got this for $89. Oh, it went up to $99. Oh, and now what did I get? Yeah, I paid $89 for this. But anyway, it had good reviews when I bought it. I don't know, it was fine for me. Anyway, people got mad at me on Instagram. They're like, Kevin, you're not supposed to wear snow camo in the snow. Like, whatever, man. So anyway, I bought this because it had like overnight shipping or whatever available. And I'm like, sweet, thanks. So like, how do you overnight me a ski outfit for $89 with free shipping? It didn't make sense. You just can't make money. I don't know, whatever. Like, I'll gladly take advantage of it. So, it's kind of like the short shorts, man. $18. It's crazy. Yeah, I live in a small town and Amazon is a lifesaver. But Casey, You're supposed to support local stores because you're supposed to pay more and support local business owners who don't have what you want. Oh, man. All right. I gotta go. I gotta go make some coffee. I'll see y'all tomorrow. Bye.